Hi, everyone. Today we're diving into an exciting topic in finance: futures contracts. Whether you're interested in commodities like oil and corn, or even modern assets like Bitcoin, futures play a huge role in global markets. Let's break it down together. So, what is a futures contract? It's a legally binding agreement to buy or sell a specific asset at a predetermined price on a future date. Think of it as making a deal today for something you'll exchange later. These assets can be commodities, currencies, stock indexes, interest rates, or even Bitcoin. Why do people use futures? There are two main reasons: hedging, to manage risk. For example, airlines hedge against rising fuel prices. Speculation, to try to profit from price movements. Traders bet on where prices are headed. Let's look at the key features of futures contracts. Standardization. Exchanges like the CME define the size, quality, and delivery. For instance, one crude oil futures contract equals 1,000 barrels of oil. Leverage. You don't pay the full value up front, just a margin deposit. This boosts both potential gains and losses. Marking to market. At the end of each day, accounts are adjusted for price changes. This keeps the system fair and reduces default risk. Settlement. Some contracts end with actual delivery of the asset, but many, like stock index futures, are settled in cash, with only profit or loss exchanged. Here's a practical example. Imagine an airline worried about rising fuel costs. Today, jet fuel is $2 per gallon. The airline buys oil futures at $2.10 for delivery in 3 months. Outcome 1. If the market price jumps to $2.50, the airline gains 40 cents per gallon on futures, which offsets the higher real-world cost. Outcome 2. If prices drop to $1.80, the airline loses 30 cents on futures, but it benefits from cheaper fuel. Either way, futures help them manage uncertainty. So, why are futures important? Hedging. Farmers, airlines, and businesses use them to stabilize costs. Speculation. Traders use them to chase profit. Arbitrage. Investors exploit price differences across markets. Price discovery. Futures markets reflect expectations about future supply and demand, guiding decisions across the economy. To sum up, futures contracts are powerful tools that can manage risk, enable speculation, and shape global prices. They're essential in modern finance, and understanding them is key to becoming financially literate. This concludes our discussion about the future contracts. Thanks for watching, and I'll see you in the next lecture.